Good morning and welcome to Bulls, Bears, and the Bell Weekend Edition. We're diving deep into the market outlook for the week, starting October 13th, 2025. And wow, this feels like a really critical moment.
Yeah, it really does. It's shaping up to be a massive battleground.
Ah.
We've got corporate health on one side, and then all these big macro and geopolitical worries piling up on the other. It's intense.
If you're heading into this week without a clear plan, I mean, you could get seriously whipsawed.
Absolutely. It's a very complex setup. You have this huge AI-driven rally that pushed us to records.
Right.
But now it's slamming right into two major systemic risks at the same time. Understanding these is, well, essential before Monday's open.
Okay, let's break those down. They're really the core of our deep dive today. First up, you mentioned the data vacuum.
Right.
We've got this U.S. government shutdown dragging on, what is it now, 10 days?
10 days deep, yeah.
Right.
And it means visibility is way down. The economic data we usually rely on, it's becoming unreliable.
So the scoreboard, the official numbers like CPI, retail sales, it's either broken, delayed, or maybe even like corrupted.
Corrected is a strong word, but potentially yes.
Yeah.
Less reliable, for sure. And that data problem feeds straight into the second big risk, the earnings gauntlet.
Okay.
Because if you can't trust the big macro numbers, where does the market look? It looks inward.
Towards companies.
Exactly. Q3 corporate results, especially from the big banks, they go from being just important to being, well, paramount. They effectively become the only real-time check on U.S. economic health.
So investors are kind of forced to guess national trends based on single company reports?
Pretty much. Which brings us to the big question for you, listening right now. How do you make smart decisions when the official economic scoreboard is effectively offline and the main signals are these quarterly reports that are, usually backward-looking anyway?
It sounds like the old playbook might not work here. We need to adjust.
Totally. It demands what we call a cross-asset focus. You have to look inside the market. Who's buying what? Where's the money flowing outside of stocks? That's where you find conviction.
Or find the hidden fear.
Exactly. And you've got to game out what the Fed might do, even if they're flying blind. And of course, watch how the technical levels hold up under all this pressure.
Okay, let's set the stage first. Before looking ahead, we need to unpack the week we just had, October 6th to the 10th. It was wild.
Astonishingly volatile is a good way to put it.
It started, maybe surprisingly, with a lot of optimism, didn't it? Almost complacency.
Yeah, that initial strength was a bit deceptive. Midweek, the S&P 500 and the NASDAQ actually hit fresh all-time highs.
Even with the shutdown going on.
Right. They were largely shrugging it off. Investors seem to be thinking, okay, shutdowns are political noise. They end eventually. Doesn't really hurt long-term profits. The known risk, the shutdown, was kind of ignored. AI themes were still the main driver.
But then came Friday, October 10th. The descriptions I've seen call it an abrupt and violent halt. What flipped the switch so fast?
It was completely external, totally unexpected. A sudden, sharp escalation in U.S.-China trade tensions.
The social media post.
That was it. President Trump posting about threatening massive new tariffs. That sudden, unpredictable threat, maybe not a black swan, but definitely a dark gray one, it just instantly triggered a huge risk-off wave. Everyone ran for the exits.
The contrast is really telling, isn't it? The market ignores the slow burn shutdown, but reacts violently to the sudden trade threat. What does that signal about underlying sentiment?
It signals fragility. Deep fragility. The market could handle the known mess of the shutdown for 10 days, treat it like background noise.
Right.
But it had zero tolerance for a new, potentially catastrophic headwind, like a huge trade war. The damage shows it. All the week's gains. Gone. Wiped out Friday.
We just said the numbers.
The Dow dropped 485 points. That's about 1.05%.
Yeah.
S&P 500 down 0.8%. And the NASDAQ, the tech index that led the way up.
Led the way down.
Exactly. Nearly a 2% slide.
So the key takeaway on sentiment is the bullishness we saw earlier in the week. It was shallow, no real conviction behind it.
Precisely. It suggests those record highs were maybe driven by a narrow group or just momentum algos. Because the second a real systemic fear hit, they folded instantly.
Sell first, ask questions later, especially on trade.
That's the mode right now. So heading into this week, the closing levels reflect that sharp pivot. S&P 500 ended at 6,735.11, Dow at 46,358.42, NASDAQ finished at 23,024.63.
So we're starting this week from a place that feels technically shaky and emotionally fragile, poised between these huge forces.
We're definitely fragile.
Okay, we've set up this idea of a split market AI booming while other parts struggle. Let's dig into that. This tale of two markets, or what we're calling the Great Divergence. AI super theme versus rising macro fear.
Yeah, this divergence is really the defining thing right now. The bull story isn't broad, it's incredibly focused, hyper-concentrated, really, in that whole AI ecosystem.
And it's not just about chips, right?
No, it's bigger. It's like a massive multi-year theme that's sucking in capital.
Let's look at some examples, because the numbers really show this concentration. Advanced micro devices, AMD, surged over 30% last week.
A phenomenal move, just huge.
What drove that? It was the OpenAI partnership news, wasn't it?
Yeah, that strategic partnership announcement, the market read that as a huge signal. Basically, that AMD is really making inroads using its new accelerator chips to grab serious data center market share.
So OpenAI is like the kingmaker.
In a way, yeah. Partnering with them is seen as like the golden ticket for spending in data centers. That 30% jump wasn't just about one deal, it was the market suddenly rethinking AMD's entire long-term potential in this AI arms race.
And like you said, that lists the whole ecosystem. NVIDIA obviously hit a new all-time high, too. What was the specific catalyst there amid all the noise?
For NVIDIA, it was getting U.S. approval for big chip exports to the UAE. That told investors that even with tighter export rules overall, key pathways for these high-end AI chips are still open, especially to certain partners. It just reinforces the idea that the global AI build-out is still going full steam ahead, kind of regardless of the shutdown stuff.
And it's not just hardware. You mentioned the ecosystem effect. We saw it in software, too, like with the PathPath, up over 30% as well.
Absolutely. That shows investors are separating things out. They're not just buying any tech stock.
They're looking for those specific AI links.
Exactly. UiPath's jump comes from the belief that its partnerships with OpenAI, NVIDIA, Google, they make it a direct software winner from the AI boom. It's pure thematic investing, money flooding into names tied to the AI story, and just ignoring the macro worries hitting everything else.
But that's only half the picture, like you said. The other side is the bear story. This growing macro anxiety pushing money into defensive stocks.
Right.
What's that rotation telling us?
It's telling us big money is bracing for a slowdown. Utilities were the best sector last week, up about 1.28%.
Classic defensive move.
Textbook. Consumer defensives also did well, up nearly 0.5%. These are the places capital hides when it's worried about the economy. Less tied to GDP swings, stable dividends, reliable demand.
And the stocks getting hit? Tell the other side of that story. Energy was the worst performer.
Yeah, energy got hammered, down over 4%. It basically tracked WTI crude oil prices falling sharply.
Because of global demand fear?
Directly tied to global demand, yeah. Fears of that renewed trade war with China kicked in. The thinking is, trade war hits global growth, factory activity slows, energy demand drops. Simple as that. And it wasn't just energy. All the cyclical areas got hit hard. Industrials, materials, consumer discretionary, all down. Shows less confidence in spending, both corporate and consumer.
And this is where we start to see maybe the first real-world impacts of the shutdown, even before the official data gets delayed. You mentioned FedEx, FDM.
Right. FedEx is a classic bellwether, right? Tracks the movement of actual stuff. JP Morgan downgraded them, citing weakening volumes in a key segment. That's a direct signal of economic slowdown. It's real data cutting through the fog.
And importantly, the analysis lends this partly to the shutdown's initial drag, right?
Yeah.
Weakening freight plus maybe the first missed paychecks for federal workers. It suggests the market's starting to price in a real economic hit, not just political noise.
Precisely. That quiet weakening in sensitive areas, that's the data vacuum starting to bite. It gives us clues that the official government stats, when they eventually come out, might confirm this weakness. It's why company commentary is going to be so incredibly important this week.
Okay, we've seen this sharp split in stocks, but often the real fear, the real conviction shows up elsewhere. Let's look cross-asset, starting with Treasury's fixed income. That Friday risk-off move definitely sent people running for government bonds.
Yeah, classic flight to safety. When panic hits, investors often pile into U.S. government debt. That demand pushes yields down.
What did we see specifically?
The benchmark 10-year Treasury yield dipped below 4.18%. Maybe more importantly, the 2-year yield, which is super sensitive to Fed expectations.
Right.
That fell about 5 basis points, down to around 3.529%. That move, especially in the short end, was directly linked to the renewed China trade fears. The market basically saying, okay, if there's a trade war, the Fed's going to have to cut rates to cushion the blow.
Okay, now commodities.
Yeah.
The contrast here is huge. And historic gold, it's surged past $4,000 an ounce for the first time ever. That's
Yeah.
a massive milestone.
Monumental is the right word, and honestly, it's probably the most worrying signal out there right now.
Why? Isn't gold just about inflation?
Not this time, or not just inflation. The analysis suggests this rally points to something deeper, a concern about the actual credibility and stability of the whole fiscal and monetary policy system.
Walk us through that. How does a shutdown and rising debt make people question policy credibility?
Well, think about the mix of things happening. You've got political dysfunction, the shutdown, the huge deficits that seem uncontrolled. That signals the political side, Congress and the Treasury, maybe can't govern fiscally responsibly.
Okay.
Then you have the Fed, forced to make critical rate decisions that affect everything globally. But they have to do it using potentially bad estimated data because the government isn't fully working.
So investors are looking at this and saying, if fiscal policy is a mess and monetary policy is flying blind, the whole system based on fiat currency feels less reliable.
That's the interpretation. Gold hitting $4,000. That's capital actively looking for something outside the normal political and financial system. It's not just hedging inflation, it's hedging against the risk of systemic failure. The fear that government dysfunction forces the Fed into mistakes that devalue the currency or that the debt just becomes too much. It's really a crisis of trust showing up in the gold price.
That puts a totally different frame on it. It's not just a hedge, it's a warning signal about the system itself.
Wow. Meanwhile, other commodities seem to confirm the global growth worries. WTI crude oil dropped sharply, below $61 a barrel.
Yeah, oil gives you a really clean read on the trade war fear. It fell explicitly because of global demand worries tied to those tariff threats. Oil traders are betting a trade war is coming, and if China gets hit hard, manufacturing slows, transport slows, oil demand drops, period, regardless of supply right now.
And farm goods, soybeans, corn, wheat also down. Again, China.
Directly China. China buys enormous amounts of U.S. agricultural products. Any hint of worsening trade relations means immediate pain for U.S. farmers, canceled orders, lower exports. It's another clear sign across different assets that the geopolitical tension is hitting global trade expectations hard. And finally, volatility. The VIX, the fear gauge. It was pretty calm most of the week, right? Suggesting people weren't rushing to hedge against the shutdown itself.
Exactly. It stayed relatively low midweek, but it definitely ticked higher into the close on Friday, ending around 16.59.
So that spike confirms the earlier point.
Yeah.
The market was okay with the known shutdown risk, but the sudden trade fear was the real catalyst that made people buy protection.
Precisely. The VIX spike shows that reflexive hedging activity kicked in right at the end of the week. The market is now priced for more bumps ahead.
All right, let's pivot to the outlook for this week, October 13th to 17th. The big story, as we've discussed, is this macro fog. The shutdown causing this profound lack of visibility, potentially corrupting key economic data.
It's an analyst's nightmare, really.
Yeah.
High risk of delays, yes, but also just fundamental unreliability in the month's most crucial economic reports.
Which specific reports are we talking about?
Well, the big ones. Consumer Price Index, CPI, that's scheduled for Wednesday the 15th. Then retail sales and the Producer Price Index, PPI, on Thursday the 16th. These are usually huge market movers, inflation, consumer spending.
But why might they be unreliable even if they manage to release them?
It comes down to this issue of imputed data. See, the Bureau of Labor Statistics, the BLS, even if they get people back in to release the September data,
Right.
they haven't been able to do their normal collection for the October data, which they should be gathering right now. Normally, they have people physically checking prices in stores. Can't do that during a shutdown.
So if they can't collect the real prices, what do?
They have to estimate more. That's
Yeah.
imputation. They use historical trends, maybe last month's changes, or data from easier to track areas like energy, and they sort of spread those estimates across other categories where they couldn't get real prices.
So the October CPI report, if we even get one, could have a much bigger chunk of estimated data instead of actual observed prices.
A significantly higher proportion, which means the accuracy, the validity of the report goes way down. You could get a big swing in the inflation number up or down. That's just a statistical fluke from the estimating process, not what's really happening with prices.
So the data isn't just delayed, its quality is actively degrading.
That's the key point, degrading quality. So even if a number comes out, smart money has to take it with a huge grain of salt. The risk of misinterpreting it is much higher.
And this mess creates a huge problem for the Federal Reserve, right? They always say they're data dependent. How can they depend on potentially bad data? This sounds like a major risk of policy error.
That's the number one macro risk this week, I'd say. If the Fed is forced to make decisions using unreliable inflation numbers and maybe just gloomy anecdotes from companies,
Which will naturally sound bad because of the shutdown and trade fears.
right, they might think the economy is much weaker than it actually is underneath all the temporary noise.
So they could overreact, cut rates too much based on a temporary dip.
Exactly. They might misread a short-term, shutdown-induced slump as a permanent downturn, cut rates aggressively, and then, boom, once the government reopens, maybe underlying demand is still strong, and now you've got too much easy money sloshing around, potentially causing inflation problems down the road. That's why the lack of good data is so dangerous.
Yet, despite all this uncertainty for the Fed, the market seems pretty convinced about what they'll do next. Expectations for more rate cuts have firmed up.
Yeah, the futures market is now fully pricing in 2 more 25 basis point cuts in 2025.
Wow.
It suggests investors think the sheer lack of visibility, plus the weak company stories and the geopolitical heat, will basically force the Fed to ease up, almost regardless of what the data actually says. The uncertainty itself becomes a reason to expect rate cuts.
Okay, so with the macro fog making government data unreliable, all eyes turn to companies. This brings us squarely to the earnings gauntlet. Q3 earnings season is suddenly critical. It's like the de facto economic data now.
And first up, the banks. This week is absolutely dominated by the big U.S. banks. They give us that crucial real-time window into consumer health, credit quality, lending, stuff the government numbers usually tell us but can't right now.
Which banks are reporting?
It's a packed schedule. Tuesday morning is huge. JP Morgan Chase, JPM, Goldman Sachs, GS, Citigroup C, Wells Fargo, WFC.
Okay.
Wednesday, we get Bank of America, BAC, and Morgan Stanley, MS. Then, wrapping up the financials on Friday is American Express, AXP. It's an incredible concentration of financial system data in just a few days.
When you're looking at these bank reports, what are the key things to watch beyond just the headline profit number?
3 main things. First, net interest income, or NII. That's the money they make from loans minus what they pay for deposits. With rates shifting, banks have had trouble keeping NII up, so seeing stabilization there is key for profitability.
Okay. Second, probably reflecting the macro stress, is credit quality.
Absolutely critical. We'll be watching provisions for credit losses very closely. That's the money banks set aside because they expect some loans won't be paid back.
So if that number jumps up,
If provisions increase significantly, it means management sees trouble ahead for consumers or businesses. Are those missed federal paychecks starting to show up as strain on credit cards or loans? That would be a big recessionary flag.
so if JP Morgan or Citi dramatically increase their loan loss provisions, it's like management saying, yeah, we think things are going to get tougher.
Exactly. That's data the Fed will absolutely be watching. And third, maybe the most important for market reaction this week is the forward-looking commentary from the CEOs.
What they say on the calls.
Yeah. What do they see coming? What's the impact of the shutdown, the trade tensions on their customers, on loan demand? That commentary could set the tone for the whole market.
Because if a giant like JP Morgan sounds confident, it could calm nerves, maybe suggest the economy's okay underneath the noise. But if they sound cautious,
It could really accelerate the downturn, especially since there's no positive macro data to offset it right now.
it creates this weird feedback loop, doesn't it? Like a surprisingly strong bank report might actually make the market think the Fed won't cut rates as much, which could hit stocks.
It could. It makes trading these reports very tricky this week. High volatility is almost guaranteed around those releases.
Okay, beyond the banks, we also need to check on that other part of the market, the AI super theme. Huge enthusiasm last week, but we get some key reports midweek from the semiconductor supply chain.
Right, we shift focus to the guys who make the AI build-out possible. ASML holding the Dutch company that makes the super advanced chip-making equipment reports Wednesday.
Yeah.
And then Taiwan Semiconductor, TSM, the world's biggest contract chip maker, reports on Thursday.
How do these reports test the AI story?
They're the ultimate reality check. Those huge valuations for AMD and NVIDIA last week, they depend on continued massive spending on making more chips. ASML and TSM give us the earliest glimpse into those capital spending plans, the CapEx.
So if TSM signals they're pulling back on spending,
Then that whole narrow AI bull case could unravel fast. It would suggest that maybe, despite all the hype, the actual financial commitment to building the infrastructure is slowing down. That would make last week's rallies look very suspect, very unsustainable.
so ASML and TSM are almost as important as the banks this week, just for different reasons. They hold the key to that bull narrative.
Absolutely. If TSN comes out strong on CapEx, the AI party probably continues. If they sound cautious, the whole divergence theme could collapse and the bears really take over.
Okay, let's look at the charts now. Do a quick damage assessment. That Friday sell-off really changed the market's character, didn't it? Yeah, it doesn't feel like that smooth, low volatility uptrend anymore. Feels much choppier, more volatile, both ways.
Agreed. It's a two-way street now. Sharp moves up and down are likely. Looking at the S&P 500, the structure took a definite hit. It broke below that steep upward channel it had been respecting since May.
What's the significance of breaking that kind of trend line?
It signals a major shift in mood, in momentum. That rapid climb we saw, that momentum is gone. Now, the relative strength index, the RSI, might be getting near oversold, so maybe you get a quick bounce.
The technical bounce.
Right. But the main trend line is broken. That puts the medium-term picture in doubt. We need to watch support levels really carefully now.
Where's the first line of defense for the S&P 500 bulls?
There's an immediate zone around 6,570 to 6,600. But the really big one, the key bull bear line in the sand, is a bit lower. 6,490 to 6,512.
Why is that zone so important?
Two reasons. It was the area of the previous all-time highs old resistance should become support. And, crucially, it lines up pretty well with the 200-period moving average.
The 200 period. That's a big long-term trend indicator. Breaking below that would be serious.
Very serious. It wouldn't just be a correction. It would signal a potential shift in the primary uptrend that's been in place for months. If 6,490 breaks decisively, expect a lot more selling, technically driven selling, as long-term players might be forced out.
Okay, over to tech, the NASDAQ composite. It got rejected pretty hard from a resistance level.
Yeah, a key Fibonacci extension level, up around 25,200 to 25,300. Briefly, for listeners, Fibonacci levels are calculated based on prior market swings, and lots of trading algorithms use them as profit targets or reversal points.
So hitting that ceiling and reversing sharply confirms that upside momentum is facing real technical headwinds now.
Exactly. And now the NASDAQ is testing the bottom edge of its own steep channel. Where's the key support there?
Support for the NASDAQ channel is right around 24,400. That's the immediate line. If it fails to hold there, you'd probably look for a retest of the August highs, which should now be support, around 23,950 to 24,020.
So 24,400 is the number tech investors are watching like a hawk this week. Breaking it suggests a deeper pullback for those big AI winners.
And finally, the Dow Jones. It's looked weaker than the others for a while now, hasn't it?
Yeah, persistent relative weakness. It failed up near 47,000 and already broke below its 50-period moving average, which is a shorter-term trend indicator.
Where's support for the Dow?
The technical picture there is the weakest, frankly. It's testing a really critical pivot zone right now between 45,650 and 45,750.
And if that breaks?
That would be a clear bearish signal for the more industrial cyclical side of the market. You'd probably target the big round number, 45,000 next. It really suggests those trade-sensitive stocks in the Dow are already pricing in a significant growth slowdown.
Okay, so let's try to pull all this together. Technical damage, macro fog, earnings pressure. What's the overall outlook, and what are the absolute key catalysts to watch this week?
Well, the base case is still, maybe surprisingly, moderately bullish, but only just.
Why bullish at all?
Mostly because we still think the AI narrative is powerful enough to bring in dip buyers, and because the market expects the Fed to step in and ease things because of all this uncertainty. But, and this is a big, but volatility is going to be sky high. Friday showed nobody wants to hold big, long positions into this kind of mess.
Okay, catalyst number one. Has to be the bank earnings, right? Especially the commentary.
Without a doubt. Positive, confident talk from CEOs could stabilize things. Cautious talk could trigger the next leg down because there's no good macro news to counter it.
Catalyst two.
Geopolitics. Any more trade talk, any headlines on tariffs from the U.S. or China, that surge in rare earth stocks on Friday. That tells you the market is already actively pricing in supply chain risks from this. Any escalation will likely mean stocks down, safety assets up.
And catalyst three, the government shutdown itself.
Yep. Any sign of progress towards ending it, or conversely, signs it's dragging into a third week, that will swing sentiment hard. If it looks like it's continuing, fears about the economic hit will grow, putting huge pressure on those technical support levels we talked about.
And a break of those levels could become its own catalyst.
Exactly. A decisive break below S&P 6,490 or NASDAQ 24,400, triggered by bad earnings or trade news, could unleash significant technical selling. That's the third major risk factor.
So wrapping it up, it feels like the market's flying blind. No reliable government data, forced to rely on corporate earnings for clues about the whole economy,
Hmm.
and all this while balancing on the edge with trade war fears and policy uncertainty.
Hmm.
It's a lot.
It's a very challenging environment. Demands caution, but also focus on those few areas like AI where there is still some conviction, at least for now.
Before we go, let's just circle back to that most dramatic move last week.
Yeah.
Gold hitting $4,000.
Yeah.
We talk about how it seems driven by deeper anxiety, fiscal mess, political chaos, worries about policy credibility, not just inflation.
It suggests real skepticism about the underlying system.
So here's the final thought, maybe something for you, the listener, to really chew on. If big money is moving into gold, not just as a hedge, but because they genuinely fear the stability of the whole system, the deficits, the politics, the risk of Fed mistakes, what does that imply about how safe they view traditional safe assets like treasuries or even the U.S. dollar long term?
It raises a really fundamental question. Is this flight to safety we're seeing just about dodging short-term market bumps? Or is that $4,000 gold price actually a deeper, more worrying signal, a signal of eroding trust in the entire financial and political setup we rely on?
Something to definitely ponder as you figure out your strategy for this very uncertain week ahead.